Yesterday, the S&P 500 hit an all-time high. Let that sink in. Yesterday, all-time high, record close, green across the board. Nasdaq up 2%. CNBC anchors doing their best impression of people who have forgotten what a bear market feels like. The mood on the street was good. Earnings season has been solid. The AI trade is back. The ceasefire with Iran, fragile and technically not fully holding but technically still called a ceasefire, had given the market the excuse it needed to run. And then this morning at 8:30 a.m., the Bureau of Labor Statistics dropped the April CPI report, and the party did not stop. But someone turned the music down. Here are the numbers. Headline inflation, 3.8% annually. That's up from 3.3% in March. It's the highest inflation reading since May 2023. The monthly rate came in at 0.6%, which was in line with estimates. But the annual number was above the 3.7% consensus. And then core inflation, the measure that strips out food and energy, the one Fed officials say they actually care about, because it represents underlying price pressure that can't be explained away by an oil shock, came in at 0.4% monthly and 2.8% annually. Both of those were above what Wall Street expected. The monthly core rate was the highest since January 2025. And there was one more number buried in the report that most financial media skipped right past, because it doesn't make a good headline for the morning rally narrative. Real average hourly wages fell 0.5% in April and are now down 0.3% annually. Which means for the first time in 3 years, American workers are earning less in inflation-adjusted terms than they were a year ago. The cost of living is rising faster than paychecks, and has been for 2 straight months now. Energy, predictably, was the headline villain. The energy index rose 3.8% in April and accounted for over 40% of the total monthly increase. Gasoline is now up 28.4% year over year. Oil is sitting above $100 a barrel, WTI at $106, Brent north of $114. That's the direct consequence of the Strait of Hormuz disruption. That part is obvious, and everyone's been talking about it. But here's the part that should actually make you uncomfortable, because the energy story is the one everybody already knew about. What nobody was positioned for was the breadth of the April print beyond energy. Shelter costs rose 0.6%, their biggest monthly jump since September 2023. Airline fares are up 20.7% over the past 12 months. Airline fares are up 0.7%. Household furnishings up 0.7%. Food at higher not just by oil, but by rent, airfares, food, and tariff-sensitive goods all accelerating simultaneously. One economist described it well this morning. He called it a consumer double squeeze, the acute pain of the energy spike hitting at the same time that most other major spending categories are also moving higher. There's no escape valve. When it was just gas, you could cut back on driving. When it's gas and groceries and rent and flights, there's no category left to absorb the shock. You just pay more. So that's the CPI report. Now let's talk about why the timing of this particular CPI report, on this particular day, creates a problem that is genuinely different from anything we've seen in this market cycle. Because the math has always been uncomfortable. But what changed this morning is who now has to solve it. Jerome Powell gave his last press conference as Fed chair on April 29th. He held rates at 3.5% to 3.75%. He said the word uncertainty so many times reporters started keeping a tally. And then he said, "Thank you very much, everyone. I won't see you next time," put his glasses in his pocket, walked out. End of an era. On May 15th, 3 days from now, Jerome Powell's term as Fed chair officially ends. His replacement is Kevin Warsh, and you need to understand exactly why Kevin Warsh was chosen and what he was expected to do, because it makes this morning's inflation report roughly 10 times more explosive than it would otherwise be. Kevin Warsh is a former Fed governor. He's a Yale law grad, worked at Morgan Stanley, joined the Fed board in 2006. Smart guy with serious credentials. Nobody disputes his resume. But the reason Donald Trump nominated him, the reason Trump spent years publicly pushing for Warsh, the reason Warsh's nomination was explicitly tied to a stated desire to influence monetary policy in a specific direction, is that Kevin Warsh, more than almost any credible candidate on the list, had publicly signaled openness to cutting interest rates. Trump wanted lower rates. Trump was not subtle about wanting lower rates. The fight between Trump and Powell over rate policy became one of the most public institutional conflicts in Federal Reserve history. There were threats. There were legal maneuvers. There were genuine questions about whether a sitting president could fire a Fed chair, which the Supreme Court eventually weighed in on. The whole episode was ugly and historically unusual. And after all of that, after 2 years of public pressure campaigns, legal fights, and political theater, Trump finally got his guy. Kevin Warsh, a nominated Fed chair who the market widely interpreted as being aligned with the administration's preference for looser monetary policy. There was only one problem. The inflation was already coming back before Warsh was even confirmed. And now this morning, 3 days before Warsh officially takes the chair, the April CPI print just told the entire financial world that the new Fed chair, who was selected in part because the president wants lower rates, is inheriting an inflation environment that makes cutting rates both economically indefensible and politically toxic. Because here's the trap Warsh is walking into, and it is a genuine trap. It is not a minor inconvenience. It is a structural dilemma that has no clean answer. Inflation is at 3.8%. The Fed's target is 2%. There is a 1.8 percentage point gap between where inflation currently is and where the Fed is supposed to keep it. Core inflation, again, the measure that strips out the Iran war noise and shows underlying price momentum, is running at 2.8% annually and accelerating month over month. The shelter component, which makes up roughly a third of the entire CPI basket, just printed its biggest monthly increase in over 2 years. The inflation problem is not just oil, it is broadening. This means that by any traditional, textbook, conventional measure of central bank policy, the appropriate response is to either hold rates where they are or raise them, not cut them. Because you don't cut rates when inflation is running 90 basis points above your target and accelerating. But Warsh was also confirmed in a political environment that made it crystal clear the administration expects monetary policy to support growth, not constrain it. Trump's one big beautiful bill is adding fiscal stimulus to an economy that is already running hot. The deficit is above $1 trillion annually. Government spending is the economic floor right now. And that spending, on top of oil-driven energy inflation, on top of shelter inflation, on top of tariff-driven goods inflation, is the perfect cocktail for inflation to not just persist, but become entrenched. And if Warsh cuts rates into this environment, he will be the central banker who let the second inflation wave go. He will be the Arthur Burns to this cycle's Jerome Powell. If you don't know Arthur Burns, he was the Fed chair under Nixon in the early 1970s, who let inflation get out of control, caved to political pressure, cut rates too early, and helped turn what could have been a manageable inflation spike into a decade-long wage price spiral that took Paul Volcker hiking rates to 20% to eventually break. The 1970s stagflation story that everyone keeps bringing up in 2026. Burns is why it was that bad. And the last thing any serious central banker wants on their legacy is to be the guy who was Burns. But if Warsh doesn't cut rates, if he holds the line, keeps policy tight, and accepts the political fallout, he risks being the man who broke the market and the economy while sitting in a chair he got specifically because the president thought he'd be more compliant than the last guy. Which creates political pressure of a magnitude that is genuinely unprecedented in modern Fed history. This is the trap. Cut rates, you risk an inflation spiral. Hold rates, you inherit the political heat for keeping borrowing costs elevated. And in the background, you have an economy that is sending conflicting signals at a frequency that would give any central banker a headache. GDP growth remains resilient. Earnings are strong. S&P 500 earnings estimates just got raised to 18.6% for the full year. The labor market, while softening at the margins, is not in distress. Consumer spending is holding up even as consumer confidence hits all-time lows. The 77% of Americans who told Pew Research they have a negative view of the economy are still swiping their credit cards. The vibe is terrible, but the data is mixed, and in central banking, the data is all that's supposed to matter. Now here's where the market angle makes this even more interesting. Because the market's reaction to this morning's CPI print tells you exactly how leveraged the current rally is to the assumption of easy money. In the 2 hours after the report dropped, futures pricing for interest rates shifted dramatically. CME FedWatch, which tracks real-time market bets on where rates are going, effectively zeroed out the probability of any rate cut between now and the end of 2027. Not reduced, zeroed. Whatever slim possibility traders were still carrying of a 26% cut evaporated with one inflation print. And then it went further. Market pricing now shows over a 30% probability, roughly 1 in 3 odds, of a rate hike by December 2026. Not a hold, a hike. That is a complete reversal of the narrative that has been driving risk asset prices for the past 6 weeks. Because remember, the reason the market ripped 13% between the late March lows and the recent all-time highs was a combination of factors. The ceasefire, the short squeeze, the CTA momentum flip, the Q1 earnings beat. But underneath all of it was a quiet assumption that had been building since late 2024, rates are coming down, money is getting cheaper, and the valuation multiples that look stretched at a 3.5% Fed funds rate will look perfectly reasonable once rates start to fall. That assumption was priced into every high multiple tech stock, Every overvalued AI name, every momentum trade that has driven this market's upper decile performance over the past quarter. This morning's CPI report didn't just raise inflation, it put a bullet in that assumption. Because the Fed isn't cutting rates into a 3.8% inflation print with core running hot and shelter accelerating. No serious central bank does that. And a market that has been partially justified by the anticipation of cheaper money is now in a position where the math goes the other way. Higher for longer rates mean higher discount rates, mean lower present values of future earnings, mean lower fair value multiples. And in a market where the S&P is trading at 20.9 times forward earnings, still elevated relative to historical averages, the math needs to be friendly for the story to hold together. And this morning the math just got a little less friendly. The irony here is almost poetic. And I mean this not as a political statement, but as a purely analytical observation of how these things tend to play out. The administration spent 2 years fighting with Jerome Powell to get a Fed chair who would be more sympathetic to lower rates. The political battle was exhausting, historically unusual, and deeply damaging to the institutional credibility of the Fed as an independent body. And on the morning that the new chair is 3 days from officially taking the job, the inflation report drops to tell the entire world that the case for lower rates just got significantly harder to make. You couldn't write it. Actually, you probably could write it. It rhymes too well with every other version of this story we've seen across history, where the thing you wanted most becomes the thing you need least at the worst possible time. Now here's what matters for the next 6 to 12 months. Because there are really only 3 ways this plays out, and none of them are particularly comfortable. Scenario 1, Warsh holds the line. He keeps rates at 3.5% to 3.75% throughout 2026, refuses to cut into rising inflation, and absorbs the political heat. In this scenario, the high multiple parts of the market reprice. Not necessarily a crash, but a sustained multiple compression that grinds tech stocks and AI names lower while value and energy stocks hold up. The market was pricing in cuts. Now it prices in holds or hikes. The adjustment is not a one-day event. It happens slowly and then quickly. Scenario 2, Warsh cuts anyway. He finds a narrative, a softening labor market, cooling core ex-shelter inflation, forward-looking optimism, that justifies a rate cut in the second half of 2026, despite the headline numbers. Stocks rip in the short run. The market loves it. And then 6 to 9 months later, if inflation doesn't cooperate, the problem is bigger, and the Fed's credibility has taken a hit that takes years to rebuild. This is the 1970s path. It doesn't happen in a day. It happens through a series of small, politically convenient decisions that compound. Scenario 3, the Iran situation resolves faster than anyone expects. Oil falls back toward $80 a barrel within 60 to 90 days. The energy component of inflation reverses sharply. Core inflation cools on its own as the supply shock fades, and Warsh gets credit for being patient without doing anything heroic. This is the soft landing scenario, the one the bulls are praying for, and it is genuinely possible. The IEA has already flagged demand destruction beginning in Asia at current oil price levels. If supply normalizes, the math changes. But here's the honest assessment. Scenario 3, the clean, everyone wins, inflation solves itself outcome, is entirely dependent on a geopolitical situation that as of this morning is not resolved. The formal ceasefire still holds technically. But the UAE activated its missile alert system just last week after Iran-affiliated forces fired on Emirati territory. Maritime traffic through the Strait of Hormuz remains at roughly 4% of pre-war levels, down from over 130 daily transits to 5 detected by midday on the day the ceasefire was announced. The ceasefire is mostly a label applied to a situation that is still highly unstable, and the oil market is pricing in exactly that instability at $106 a barrel. So what do you do with this information as an investor? Because if you've been riding this rally since the late March lows and you're sitting on gains right now, this morning's CPI report is the first concrete piece of macro data that puts a real question mark over the assumption that made this rally work. Real wages going negative is not a headline. It's a signal. When real wages are negative, consumer spending follows with a lag. It doesn't stop immediately. People have savings, credit cards, spending habits. But after 2 to 3 quarters of negative real wage growth, consumer spending softens. And when consumer spending softens, corporate revenue growth slows. And when revenue growth slows at a moment when valuations are already above historical averages, the repricing is not gentle. The shelter component accelerating is not a headline either. It's a structural problem. Shelter is 34% of the entire CPI basket. It is the single heaviest component. It doesn't spike and reverse like gasoline. It moves slowly, stickily, and in one direction at a time. When shelter accelerates, it tends to stay elevated for quarters, not weeks. And the BLS has already flagged that April's sharp shelter increase partly reflects statistical noise from the government shutdown data gap, which means the underlying shelter trend may actually be worse than the number suggests once the distortion clears. Gasoline at $4.50 nationally is a tax on every commuter, every delivery driver, every small business that moves anything physically. It's a regressive tax that hits lower-income households disproportionately. Consumer sentiment hitting all-time lows while the stock market hits all-time highs is not a quirky disconnect. It's a description of an economy where asset owners are doing fine and everyone else is getting squeezed by the same inflation that's fueling corporate margins. That gap doesn't close smoothly. It closes through policy, through recession, or through the kind of political pressure that changes the rules of the game. And today, sitting in the middle of all of this is Kevin Warsh. 3 days from the most powerful economic job in the world, inheriting an inflation problem, a politically compromised institution, a fractured FOMC that had 4 dissenters at the last meeting, a stock market priced for perfection, and a geopolitical situation that his predecessor couldn't fully resolve either. The question everyone is going to ask Kevin Warsh in his first press conference is simple, and there is no clean answer. What are you going to do about inflation? If he says he's going to hold and watch the data, the market reads that as hawkish and reprices. If he says he's focused on keeping growth supported, the market reads that as dovish, and the bond market sells off. If he says something nuanced and non-committal, everyone reads between the lines and trades whatever interpretation fits their existing position. There is no press conference answer that makes this morning's CPI print disappear. Which brings me to the question I want to put to you in the comments. Because this is one of those moments where the market is genuinely at a fork in the road, and the people who get the next 12 months right are going to get it right. Not because they picked the best stock or timed the best trade, but because they correctly read which of these 3 scenarios actually plays out. So here's the question. What does Kevin Warsh actually do? Comment Warsh holds if you think he keeps rates steady, accepts the political heat, and lets inflation cool on its own timeline. Comment Warsh caves if you think the political pressure and market expectations force at least one cut before year-end, regardless of where inflation is. And comment Iran saves him if you think the geopolitical situation resolves fast enough that the energy shock reverses and the whole problem becomes someone else's legacy. Because right now, 3 days before the most consequential Fed chair transition since the early 1980s, the inflation report just told us one thing clearly. Whoever sits in that chair next week does not get the luxury of doing nothing. Jerome Powell said, "I won't see you next time," and walked out of the building. He knew what was coming. He just made sure it arrived after he left.